Warren Buffett's first TV interview ever. Boy, do we have a great reaction to get into here tonight, folks. Definitely one of my favorite videos on YouTube I wanted to react to here. And let's just get straight into this, guys. I appreciate everybody joining me. I think you'll get a lot of value out of this one, a lot of gems, and just a lot of greatness out of here in this one today. So I appreciate everybody. Subscribe to the channel. Let's get straight into this one. I'm so excited.
Secular approach, who have also been very successful. Let's take Warren Buffett of Omaha, Nebraska. If you would put $10,000 in 1965 into his company, Berkshire Hathaway, you would have $1 million today. Warren was a chapter in my 1972 book, Super Money, so I've known him a long time. He learned his trade with Ben Graham, the original dean of security analysis at Columbia University. I don't think Warren has ever been on television until this interview, and he has certainly never courted publicity, but recently he got a lot of it when he emerged as the key figure in the takeover of ABC by Capital Cities. Warren will be the largest shareholder of the new company, and his own net worth is now far in excess of $500 million. But when I spoke with him last fall in his office...
So the reason I'm giggling about that is $500 million is like so much money, right? Like if you have $500 million, it's like insane. But compared to what Warren Buffett has today, it's like nothing. It's like a can of soda to him. It's crazy to think like that, right? And Warren Buffett was not known at this time, and I know he's so famous nowadays that it's hard to even imagine a Warren Buffett, like, not super famous, right? But back then, like, no one really knew about him. This is obviously way before, like, social media. Heck, this is barely after the color TV days here.
In Omaha, he very characteristically made his investment style seem so perfectly simple.
The first rule in investment is don't lose. And the second rule in investment is don't forget the first rule, and that's all the rules there are. I mean, if you buy things for far below what they're worth, and you buy a group of them, you basically don't lose money.
Warren, what do you consider the most important quality for an investment manager?
It's a temperamental quality, not an intellectual quality. You don't need tons of IQ in this business. I mean, you have to have enough IQ to get from here to downtown Omaha, but you do not have to be able to play three-dimensional chess or be in the top leagues in terms of bridge playing or something of the sort. You need a stable personality. You need a temperament that neither derives great pleasure from being with the crowd or against the crowd. Because this is not a business where you take polls, it's a business where you think. And Ben Graham would say that you're not right or wrong because 1,000 people agree with you. And you're not right or wrong because 1,000 people disagree with you. You're right because your facts and your reasoning are right.
Warren, what do you do?
And what he just explained there, I mean, just there's so many gems right off the bat there. And I think one of the most important points he brings out is the temperament, right? And I'll be honest, for men, right, which the investment community is mostly men, right, in terms of stock picking, making investments, a lot of us definitely have, you have to deal with that element of just what it means to be a man and your flight and fight syndrome, right? And we're just kind of wired that way. And so in the stock market, it's like pretty much the worst way to be wired because you can make some very, very rash decisions, right? And that's the worst way to approach the market. You've got to be very steady. You hear what he just mentioned there at the beginning? He just mentioned something very important. Buying assets that are undervalued, right? He didn't mention anything about you need to wait until the S&P 500 is this number or until the 50-day moving average is over here and the 200 moving day average is over here or something like that. It's very, very simple. You research assets, see if they're undervalued, buy them when they're undervalued. If they go lower, buy some more of them, right? Throw them in the filing cabinet. If they get fairly valued or overvalued, you got a better place to put the money over the coming years, and you can go ahead and sell them off and take your profits and move on to the next one, right? It's a very, very simple approach, and that's what has always resonated with me from Warren Buffett from the time I came across him in 2008, 2009.
It's different than 90% of the money managers who are in the market.
Certainly most of the professional investors focus on what the stock is likely to do in the next year or two, and they have all kinds of arcane methods of approaching that, but they do not really think of themselves as owning a piece of a business. The real test of whether you're investing...
It's crazy because the way he's talking here, this is the same stuff today. Same stuff, all these decades and decades and decades later. And what he's speaking about is still as true today as this was many, 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 many decades ago when this, his first TV interview ever happened here, Warren Buffett, just classic.
A value standpoint or not is whether you care whether the stock market is open tomorrow. If you're making a good investment in a security, it shouldn't bother you if they close down the stock market for 5 years. All the ticker tells me is the price. And I can look at the price occasionally to see whether the price is outlandishly cheap or outlandishly high. But prices don't tell me anything about a business. Business figures themselves tell me something about a business, but the price of a stock doesn't tell me anything about a business. I would rather value a stock or a business first and not even know the price, so that I'm not influenced by the price in establishing my valuation, and then look at the price later to see whether it's way out of line with what my value is.
As somebody who's been in the market for 15 years, what he just said there is one of the best gems. I mean, this man is just loaded with gems, but that's one of the best gems. Because as somebody who's been doing this a long time, I can tell you there's been many time periods in the past where I've been influenced first by a stock price, right? And you can't do that. You really got to look business by business. Sometimes it's easy to look at a stock and be like, it's down 50%. It must mean it's a great discount. But then when you start going through the financials, what's going on with the business model, you start to realize, oh my gosh, this company's actually in huge financial problems, or their business is just falling off the rails. A good example of this recently is I looked into a company named Hasbro. Hasbro is a stock that's gotten hit very hard. And I was influenced right away from the price of Hasbro. The stock's down significantly from where it used to be. And the valuation at the surface level doesn't look that expensive. I start to dig into the financials of Hasbro, and I find a disaster zone for this company. I'm like, oh my gosh, I see why the stock is down so much. But many times investors get too in love with the price at first. Oh, it's down this much. Oh, the forward P says this. Oh, the price to sales is this. And that influences their decision making, so they go buy that stock because of that. Okay, business first, then financials, then figure out the valuation. If the valuation's right, then we can go ahead and make a purchase decision. If the valuation's not right, then we can just keep it on our watch list, whatever, right? And maybe at some point it will come down to that. There's thousands of stocks in the stock market, so that means there's thousands of opportunities in the stock market.
Buffett chose to stay in this world, Omaha, Nebraska, where corn grows just minutes from downtown. Now, Omaha is a nice town, but nobody claims it's a world financial center. Here, the only thundering herd is actually on 4 feet. Don't you find Omaha a little bit off the beaten track for the investment world?
Well, believe it or not, we get mail here, and we get periodicals, and we get all the facts needed to make decisions. And unlike Wall Street, you'll notice we don't have 50 people coming up and whispering in our ear that we should be doing this or that this afternoon.
You appreciate the lack of stimulation here?
I like the lack of stimulation. We get facts, not stimulation here.
How can you stay away from Wall Street?
Well, if I were on Wall Street, I'd probably be a lot poorer. You get overstimulated in Wall Street, and you hear lots of things, and you may shorten your focus, and a short focus is not conducive to long profits. And here I can just focus on what businesses are worth, and I don't need to be in Washington to figure out what the Washington Post newspaper is worth, and I don't need to be in New York to figure out what some other company is worth. It's an intellectual process. And the less static there is in that intellectual process, really the better off you are.
100%. 2 points. You can be anywhere in the world, well, pretty much anywhere in the world, right? Some countries may not allow you to buy stocks, but you don't have to be in New York City to be a great investor. You can be anywhere. I remember reading a story, this is probably a decade ago or now, phenomenal fund manager out of Utah, right? And so you can be anywhere in the world and be great at running money and get some phenomenal returns. You don't have to be in New York City. And like he spoke about there, if you're there, you might actually produce far worse returns because everybody's so tied up into the short term, what's going on here? And you start making these short-term decisions, which we know statistically, the more short-term decisions you start to make, the more you're likely to underperform the market over time, right? And for Warren Buffett, he has a long-term focus on these companies. So what's going to happen with the Fed tomorrow or the Fed the next day or the economy the next day or all these sorts of, guessing games, right? It's just not even really worth that attention in the end. You need to buy companies that, regardless of what happens in the economic environment, those companies can make it through. They got great balance sheets, great income statements, and they'll make it through. Their business models are proven like that, right? And so I just love his whole outlook when it comes to that.
The intellectual process is defining your area of competence in valuing businesses, and then within that area of competence, finding whatever sells at the cheapest price in relation to value. And there are all kinds of things I'm not competent to value, but there are a few that I am competent to value.
Have you ever bought a technology company?
No, I really haven't.
In 30 years of investing, not one?
I haven't understood any of them.
So you haven't ever owned, for example, IBM? Which
Never owned IBM. Marvelous company. I mean, a sensational company, but I haven't owned IBM.
And so here is this technological revolution going on, and you're not going to be a participant.
Gone right past me.
Is that all right with you?
It's okay with me.
So this was in 1985. So this was really when tech was just in its infant stage at this point in time. I believe Apple was founded just a few years before this, if I recall, right? And so this was the baby infant stages. And what he brings up here is such an important point that I think every single person watching this video right now can take away, right? Is you don't have to understand every single company. You don't have to understand every single industry, right? If you read a 10K, if you listen to conference calls of companies and you still don't get it, it's fine. There's thousands of opportunities in the stock market, man. So there's everything from sugar water companies like Coca-Cola and Pepsi and Monster Beverage to trash companies like Republic Services and Waste Management to, massive tech companies such as Apple and Microsoft to small cap companies to folks that sell paper towels and tissues. Like this, there's a whole range. And so you're going to be able to find some industries and sectors that you really understand really, really well and where these companies are going over time. You don't have to get it all. And if you don't get it all, don't feel bad about that. Warren Buffett's been doing just fine for himself without understanding every company out there in every sector and every industry, okay? And so that's just stay in your circle of competence. Stay in your circle of competence. It's key in this investing game.
I don't have to make money in every game. I mean, I don't know what cocoa beans are going to do. There are all kinds of things I don't know about. And that may be too bad, but, why should I know all about them? I haven't worked that hard.
That's a big statement he just made there, because that's the difference between Warren Buffett and a lot of these folks on Wall Street. What he just said there, that's the differentiator between him and a lot of folks on Wall Street. A lot of folks on Wall Street, they pretend like they know everything and they know where everything's going to magically go, and almost always their predictions are wrong, right? He says, I'm not going to try to predict where cocoa beans are going, right? I don't know that. I haven't worked that hard on understanding that. He's not afraid to admit when he doesn't understand or know where something's going, and even people that might study that still don't know where that is going, right? And I think that is so key. You've got to have that kind of self-humility as an investor in the market, that you're not going to understand everything. You're not going to know everything. That's the bottom line. You have the people that understand that, like a Warren Buffett here, and you have the people that don't, and they want to have a prediction about everything. And here's where I think the Treasury's going, and here's a 2 versus 10, and here's why I think this is going to happen here, and here's why this commodity over here is going to go up, and this one's going to go down. And at some point in time, you're just like, you're spread too thin. How much time are you really spending on that? There's only so much time in a day. So you're going to tell me you know where natural gas price is going, and you know where corn prices are going, and you also know where this stock is going, and you also know where the market's going, and you also know what the Fed's going to do, and you also know no one knows all that. There's not enough time in a day just to understand where the price of corn's going. You're going to have to track weather. You're going to have to track, how crops are doing. You're going to have to track so many different things just to know that one little segment there. Never mind these other million things over here.
In the securities business, you literally every day have thousands of the major American corporations offered you at a price that changes daily, and you don't have to make any decisions. You have to make nothing is forced upon you. So there are no called strikes in the business. The pitcher just stands there and throws balls at you, and if you're playing real baseball and it's between the knees and the shoulders, you either swing or you get a strike called on you. If you get too many called on you, you're out. In the securities business, you sit there and they throw U.S. Steel at 25 and they throw General Motors at 68, and you don't have to swing at any of them. They may be wonderful pitches to swing at, but if you don't know enough, you don't have to swing. And you can sit there and watch thousands of pitches, and finally you get one right there where you want it, something that you understand, and then you swing. And
so you might not swing for 6 months.
You might not swing for 2 years.
Isn't that boring?
It would bore most people, and certainly boredom is a problem with most professional money managers. If they try to sit out an inning or two, not only do they get somewhat antsy, but their clients start yelling, "Swing, you bum!" From the stands, and that's very tough for people to do.
Exactly, because think about it from the customer standpoint, right? They're like, if the money manager is not doing anything with the money, why are they even holding on to it? I could hold on to my own cash if I wanted to hold on to cash, right? I'm giving you that money so you can invest it for me, not so we can just sit there do nothing, right? And also, if they see other people getting returns or those sorts of things, they're kind of like, why am I not getting these returns that other people are getting?
Your approach seems so simple. Why doesn't everybody do it?
Well, I think partly because it is so simple. That the academics, for example, focus on all kinds of variables. Partly because
by academics, you mean professors of finance?
Yeah, the data's there.
In business school?
Sure, and the data's there. So they focus on whether if you buy stocks on Tuesday and sell them on Friday, you're better off, or if you buy them in election years and sell them in other years, you're better off, or if you buy small companies. There are all these variables because the data are there, and they've learned how to manipulate data. And as a friend of mine says, to a man with a hammer, everything looks like a nail. And once you have these skills, you just are dying to utilize them in some way, but they aren't important. If I were being asked to participate in a business opportunity, would it make any difference to me whether I bought it on a Tuesday or a Saturday or an election year or something? It's not what a businessman thinks about in buying businesses. So why think about it when buying stocks? Because stocks are just pieces of businesses.
Yeah, I absolutely love that. Just Warren Buffett giving out so many gems there. I hope you guys really enjoyed that. Make sure you subscribe to the channel. A lot more content coming for you guys here on the Reaction channel. Oh man, just a beautiful classic there. Thank you, Warren Buffett, and have a great day.